This is the second part of my Airbnb stock analysis, and if you haven't done so, I encourage you to watch the first part of the video where I talk more about Airbnb as a business as well as the financials of the company. With that said, let's get started on the second part of the analysis. Turning to the outlook of the company provided the following guidance. They expect continued strong demand in Q1 of 2023, especially in Europe, Latin America, and Asia Pacific. The company expects revenue of 1.75 billion to 1.82 billion in Q1 of 2023, which represents a year-over-year growth of between 16 and 21% year-over-year, as well as if it was a neutral currency exchange basis, that will be 18 to 23% year-over-year growth. So the company also explains that in Q1 of 2023, there will be an easier year-over-year comparison due to the Omicron virus and the war in Ukraine that broke out in Q1 of 2022. As such, the company expects nights and experience book year-over-year growth to be nearly as strong as Q4 of 2022. On the other hand, the company expects slightly lower ADR than in Q1 last year, and this is due to increasing downward pressure from mix shift as well as new and improved pricing and discounting tools. For full year 2023, the company expects strong adjusted EBITDA margin as the company offset headwinds from lower ADR with incremental variable cost efficiencies and fixed cost discipline. In Q1, the company expects adjusted EBITDA margin to be slightly down year over year. In other words, we can still expect strong margins in 2023, but growth, on the other hand, is expected to slow down as the company faces tough year-over-year comps. Nonetheless, Airbnb is well positioned to continue to grow and gain market share, strengthening its position as the go-to platform to book accommodations. If we head on to Seeking Alpha, we can see that Airbnb has beaten analyst estimates in 8 out of 9 of its quarters as a public company. So this could be an assurance that Airbnb will continue to outperform growth expectations. Now let's take a look at the valuation of the company. Airbnb went public in December 2020, and just like any other company that went public at that period of time, Airbnb's stock price went through the roof, almost doubling its debut price. However, the stock is now trading below its IPO price, and I think it's a healthy valuation reset for Airbnb. The reason I say this is because Airbnb was trading at unsustainably high valuations. As seen in this chart, Airbnb was trading at an EV to sales multiple of over 30 times. Today, it has compressed to a much more reasonable multiple of just 7.7 times. And if we head back to Seeking Alpha, we can see that Airbnb has a valuation grade of D-, which is pretty bad. And here we can compare Airbnb's valuation to that of peers, including Booking.com, Expedia, Marriott, and Hilton. So in terms of multiples, we can see that Airbnb has a high EV to sales multiple compared to peers. It is also high in terms of EV to EBITDA multiples, which is the highest in its peer group. In terms of price to cash flow, it is more expensive than Booking.com, but it is also in line with the hotel chains. It is also worth mentioning that the revenue growth in this peer group is pretty much in line with each other, and therefore I think the valuation multiple that Airbnb has, the premium valuation that it has, is not really well justified. And here we can see an average analyst price target of about $141 per share, which is a 25% upside from current levels. That includes a street low of $98 as well as street high of $190. So I also did a DCF model, which is pretty much very subjective, but it is also a sanity check for me to compare that to analyst price targets. So these are the assumptions that drive my DCF model. First, we have the revenue year-over-year growth. As you can see, over the last few years, these are the growth rates. And for the projections in the next 10 years, I've arrived at 14% growth in 2023, and it will go down all the way to 8%. So I got the revenue growth for the first 3 years based on analyst estimates right here. So I'll just plug that into my model, and then I'm just gonna bring revenue growth down to 8% by 2032. As for cost of revenue and operating expenses, which is gonna drive the gross margin profile and operating margin profile of of the company, I've used Booking.com's gross margin and operating margin percentages as a guide to where I expect Airbnb's margins are going to land over the next few years. So for Booking.com, we can see that the company has an operating margin of 28.69% in 2022, and the company has achieved operating margin percentages of 35% and above before, so I'm going to use that as a guide for Airbnb. So if we head back to the model, I'm going to expect operating margins to improve from 22.5% in 2022 to about 35% by 2032. For income tax, I'm going to increase that to 20% in the following years. Depreciation and amortization expense is going to be 1% in the following years as well. Stock-based compensation is going to drop from 11% all the way down to 5%. And for capex, I think Airbnb is a capital light business, and so I'm gonna keep it at negative 0.5% throughout the years. For changes in net working capital, I'm gonna keep it flat at 0%. So that leads us to a free cash flow margin of about 33%, which is lower than the 38% free cash flow margin that the company achieved in 2022. So I think this is a reasonable assumption at this point. And now, assuming a 10% discount rate and a terminal growth rate of 2.5%, I arrive at an intrinsic value per share of $135 per share. Now, this is slightly lower than the average price target set by analysts, but as you can see, the current price of $112 makes the company undervalued. But that doesn't mean that I'm going to buy the stock at this moment. For me, I like a preferred margin of safety of at least 30% in case I'm too aggressive with all my projections. So what is the price that I'm willing to pay? That is $95 per share, which is where I'm going to start a position potentially. So that is my sanity check, and as you can see, the current price of $112 make it seem that the company is undervalued based on my valuation estimate of about $135 here. However, I do prefer a larger margin of safety, so I'm just gonna wait it out and see if the company or the stock drops below $100. On the other hand, it is also worth noting that management is still well incentivized to generate stock price appreciation for shareholders. In particular, Airbnb has set up a long-term performance-based stock compensation award for CEO Brian Chesky, and the performance award are divided into 10 tranches. As you can see, the last tranche consists of a stock price hurdle of $485, which is roughly a 4 to 5x return from current prices. In addition, it can only vest in November 10 of 2030, which not only shows that management is aligned with shareholders, but also in it for the long game. So turning to the risks of the company, I think competition will be one of the major risks for the company. There are so many other platforms out there, including Booking.com, Expedia, and the big problem is that hosts list their properties in not just one particular platform, but multiple platforms, right? It's not just Airbnb, it's also in Expedia, it's also in Booking.com, and many more. This means that there are other alternatives whereby hosts and guests can easily visit and utilize other platforms that are much larger than Airbnb. An example would be Booking.com, which offers more than 28 million total reported accommodation listings, including over 6.6 million listings alone of homes, apartments, and other unique places to stay. So the next risk is recession. There has been quite a lot of talk about the global economy heading into a recession. Layoffs are getting more and more common these days. To make matters worse, raging high inflation is also destroying people's purchasing power. All of these decrease discretionary income, thus causing consumers to reduce spending on travel and leisure, which is going to impact Airbnb as a whole. And last but not least, the Bear Cave published a short report on April 6 against Airbnb, which caused shares tumbling down. So the short report argued that Airbnb has shifted towards professionally managed properties, and Airbnb's top professional hosts hosts are building out their own booking platforms and offering cheaper deals to undercut Airbnb. In other words, Airbnb's future will look like that it's competing against its best and largest hosts. The report went on to explain that professional property managers represent 1% of all vacation rental hosts but manage 23% of available listings, which generate 35% of total revenue. So if they were going to take market share for Airbnb, there's going to be a huge revenue impact for Airbnb. So in other words, professional hosts could undercut Airbnb, which may encourage guests to book directly under their own platforms, which takes market share away from Airbnb. So the short report provided an example where a certain property manager undercuts Airbnb's pricing by $125. You can see that in Airbnb it is listed at $2,266, but in its own platform it is $2,141. So the argument is because the Airbnb's listing is more expensive, more and more guests are going to book outside of the platform and into the platforms of the property managers. But do note that with the slight premium, Airbnb offers air cover, which provides additional liability protection, guarantee, and security for hosts and guests. And that is why I think most hosts prefer to list in Airbnb and guests prefer to book from Airbnb. The report also handpicked several tweets that reflect really bad sentiment towards Airbnb. Honestly, I wouldn't take these tweets too seriously, as large consumer-facing companies like Apple, Amazon, Walmart, they all face negative criticism every single day. Even the best-selling products in Amazon or the #1 podcast in the world have negative reviews. They have one-star reviews, and that doesn't really stop people from purchasing the product or listening to the podcast. I'm not saying to completely disregard short reports. I think it's a healthy thing that there's a bearish argument against a bullish investment thesis. But in this case, I think the short report lacks substance and lacks strength, and therefore I wouldn't worry too much about it. To wrap up my Airbnb stock analysis, what do I think about the company? I think Airbnb is building the ultimate hosting platform. It has a long growth runway and it can expand to other categories like peer-to-peer car rentals or boat rentals, and that will increase its revenue opportunity as well. While the growth story looks compelling, it looks like the company is facing tough year-over-year comps, and therefore growth is expected to slow down in the next few years. Regardless, Airbnb has a resilient business model, strong cash flow, and a long growth runway ahead, supported by its technology, brand, scale, and network effect moats. Personally, I like a larger margin of safety, which is why I'd be happy to start a position under $100 per share. With that said, what do you think of Airbnb stock? And also, if there's a company that you want me to cover in this channel, please leave a comment down below. With that said, thank you guys so much for watching this video. If you like it, please leave a like, comment, and subscribe to my channel so you won't miss future videos. Thank you, and I'll see you guys on the next one.